Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, right below the video there.
Exactly. So let's just jump right in. We are sitting here. It's Saturday morning, February 21st, 2026. And if you're looking at your portfolio today, specifically if you hold this stock, you might be feeling a little, let's say, queasy.
Oh yeah, probably panicked.
Right. Panicked is fair. The stock is down 24% year to date. That's a quarter of the company's value just wiped out in less than 2 months.
It's been a really rough start to the year for software, just across the board.
Yeah.
We're seeing this genuine software out right now. The market mood is incredibly fearful. Interest rate jitters are creeping back in, and traders are they're selling off indiscriminately.
Yeah, it doesn't even matter what the company's doing.
No, exactly. If your ticker is attached to cloud or SaaS, you are getting hammered.
Oh.
It's that simple.
It feels really heavy. You look at that chart, just that steep red line going down, and it feels like something is fundamentally broken with the company. But then, and I think this is where it gets super interesting, you look at the actual business reports we have sitting right here.
Right.
You look under the hood, and it honestly feels like we're living in two completely different realities.
It is the ultimate market paradox right now. It's a massive disconnect. Because on one hand, yeah, the share price is reacting to this broader macro fear, but on the other hand, the actual company is not just surviving the rout, they are absolutely exploding.
Defying gravity.
Literally, the fundamentals have arguably never been stronger.
So that's our mission for today's deep dive. We really need to figure out, is this 24% drop a warning sign? Like, is the market seeing some structural flaw we aren't? Or is this just a massive discount opportunity that we'll all look back on in 5 years and kick ourselves for missing?
Which is what Mizuho is predicting, by the way. They're calling for a sharp recovery.
Right, but we need to verify that against the hard data.
We do. And I think when you strip away that daily stock volatility, just ignore the flashing red and green lights on your screen for a minute and look at the earnings, the picture clears right up.
Let's start with the most recent hard numbers. We're looking at the Q3 2025 report. What jumps out to you first?
Honestly, the velocity, that's the only word I can use. Revenue hit $1.18 billion for the quarter.
Wow.
Yeah, that is up 62.8% year over year.
62.8%. Let's just pause on that. Because for a company of this size, usually when you cross that billion-dollar quarterly mark, you hit the law of large numbers.
Right. The growth is supposed to slow down.
Exactly. You expect it to drop to maybe 20, 30%. You're turning a cruise ship. It takes time.
But that's the anomaly here. This is actually their highest growth rate since the IPO.
That's wild.
Instead of slowing down as they scale, they're actually reaccelerating. And to give you some context on that momentum, that acceleration is up nearly 15 points from just the previous quarter alone.
They're acting like a tiny startup.
Exactly. Most companies get sluggish. They are getting faster.
Okay, so what's the engine? What is fueling this? Is it just serendipity or some massive new government spending bill?
It's 3 letters, AIP.
Artificial intelligence platform.
Yes. We've been talking about AIP for a long time, but it really feels like it's finally hit that critical mass where it's translating directly into hard revenue.
And where's the proof of that? Because everyone uses AI as a buzzword right now. Every company says they do AI.
Right, but the smoking gun here, and this is the most critical wealth-building metric for investors to watch, is the U.S. commercial sector.
Okay.
U.S. commercial revenue surged 121% year over year to $397 million.
Wait, I just want to make sure I heard that right. 121% growth.
Yes.
Just in the U.S. commercial market.
Just in the U.S. They more than doubled their business in the most competitive tech market on the planet in a single year. And again, look at the momentum. That growth rate is 28 points higher than prior quarters.
Why does that specific number matter so much? Like, why do we care more about U.S. commercial than a massive government contract over in Europe?
Because U.S. corporations are ruthless pragmatists. They do not buy hype, they buy efficiency. If a Fortune 500 company is spending money, it's strictly because the tool makes them more money.
Right, they need an ROI.
Exactly. So that 121% surge, that tells us corporate America has officially moved past the whole testing phase of AI. They're in the deployment phase now. And Palantir is the operating system they're choosing.
That is staggering. It's like the sleeping giant finally woke up. But I have to play devil's advocate here. Are these just one-time flings, like a company writes a check to try out this cool new AI thing, and then they churn out next year? Or are these customers actually sticking around?
Oh, they aren't just sticking around. They're becoming completely addicted to it. The net retention rate, the NRR, is 134%.
134%. Let's break that down for the listener who maybe isn't staring at SaaS metrics all day.
Yeah.
What does 134% actually mean for the bottom line?
It means if you completely ignored every single new customer they sign, like if the entire sales team just went on vacation for the year, their revenue from their existing customers would still have grown by 34%.
That is absurd leverage.
It is. It means once they are in, companies aren't just renewing their contracts, they're expanding them massively. They're buying new modules, adding thousands of seats, deepening the integration. And that figure, by the way, is up 27 points over the last 2 years.
That's the definition of sticky. It's like a central nervous system for the enterprise.
Yeah,
You can't just rip it out because some startup offered you a cheaper subscription.
precisely. And the crazy part is, it's not growth at all costs. That's the other half of this paradox. Usually when you see 60% top-line growth, you assume the company's just burning through cash to fuel it.
Right, the classic Silicon Valley mindset. Just hire 1,000 salespeople, buy a bunch of Super Bowl ads, and figure out profitability in 10 years. The burn rate problem.
Exactly, but they totally flipped that script. They are hitting the rule of 40 on steroids.
Remind us how the rule of 40 works.
It's a standard benchmark for software companies. You add your revenue growth rate and your profit margin together. If that number is over 40, you are considered elite. Palantir achieved 40% GAAP net margins alongside that 60% plus revenue growth.
So their score is over 100.
Yes.
But wait, 40% GAAP net margins. That is practically unheard of for a high-grade SaaS company. That's like Visa or MasterCard territory.
It is truly elite. And if you look at the Q4 2025 metrics, their adjusted operating margin actually reached 57%. So they're becoming significantly more efficient as they scale. That is operational leverage in pure action.
How are they even doing that, though? How do you grow revenues by 60% without your costs ballooning right alongside it?
It's driven by AIP itself. They are actually using their own AI software to run their internal operations.
Oh, wow.
Yeah, so it allows them to just do way more with way less. They don't need an army of middle managers because the software handles the complexity. They are their own best case study.
Okay, so looking in the rearview mirror, things are amazing. Q3 2025 was a total blowout, but the market is forward-looking. We are sitting in February 2026 today. Why should I buy the stock right now? What are they promising for the rest of this year?
They are basically promising to crush the consensus again. For the full fiscal year 2026, they guided revenue between $7.182 billion and $7.198 billion.
Which comes out to what growth rate?
61% year-over-year growth.
Wow. So they do not see this slowing down at all.
Not even a little. And they are betting incredibly heavily on that U.S. commercial sector we talked about. They guided that specific segment to over $3.144 billion.
And that represents
115% growth.
So they're effectively telling the market, hey, we are going to more than double our U.S. corporate business again this year.
Yes, it's extremely bold.
If they miss that, the stock gets slaughtered.
It does, but the analysts are buying it and modeling it out. They're forecasting 2026 earnings per share at around 56 cents on roughly a $3.2 billion revenue base. And looking longer term, they see a clear path to 1.27 EPS.
So the profitability trajectory is just as aggressive as the revenue.
Absolutely. And we can't ignore the cash flow. They're projecting nearly $5.895 billion in free cash flow by 2030.
Nearly $6 billion a year in pure cash. That is a massive war chest. So what do they do with that? Are we going to see dividends, massive buybacks?
No, and honestly, if you're an investor, you shouldn't want them to do that.
Right.
Not yet. Dividends are for companies that have run out of ideas for growth.
Right.
They are taking that cash and aggressively reinvesting it into deploying AIP everywhere. They want to capture this entire market while it's red hot. They're playing to win the whole board.
Okay, the growth is there, the cash is there. But let me play the skeptic again. Why are they safe? We have AI competitors popping up every single day. You've got BigBear.ai, you have all the big tech giants. What stops a CIO from saying, hey, love the demo, but we're going with this cheaper startup?
This is where we have to talk about the moat. And with this company, it's not just a moat. It's a fortress with 4 massive walls. They aren't selling an app. They are selling a comprehensive operating system for the enterprise.
Break down those 4 walls for us.
Okay, so you have the 4 main platforms. First is ALP, which we've covered. That's for AI operations. Second is Foundry. That is the decision-making brain of the enterprise. It's where all the siloed data actually comes together to live and breathe. Third is Gotham, which is the defense scale analytics. That's the heavy-duty stuff they originally built for the military to track threats.
Right.
And fourth is Apollo, which handles continuous machine learning deployment across all these different environments.
So it covers the entire life cycle,
Yeah.
from the raw, messy data feed all the way to the general's tablet in the field.
Exactly. And if you are a massive global corporation or a sovereign government, you cannot just tape that together using 5 different cheap startups.
No, it would be a nightmare.
It would. You need a deeply integrated system where the data talks seamlessly to the model and the model talks to the human. Once you harmonize your data across these platforms, the switching costs become astronomical.
Because ripping it out would be like ripping out your spine while you're trying to run a marathon.
Precisely. And their go-to-market strategy right now is just genius. They use these boot camps.
I hear about these boot camps on every earnings call. How is that actually different from a normal enterprise sales pitch?
Well, think about the old way SaaS was sold. You buy the CIO a steak dinner, you agree to a 6-month pilot program, the lawyers fight over the contracts for months, and maybe a year later you finally install the software.
Right. Terrible time to value.
They totally killed that model. They walk in and say, give us your actual messy data for 5 days. We will build you a working prototype that solves a real problem you have right now.
Show, don't tell.
And it works beautifully. It reduces that time to value from months down to days. The customer sees the software solving their specific problem on Monday, and by Friday they have the pen out, ready to sign. That's why that net retention rate is 134%. They get hooked instantly.
Because there's a network effect there too, right?
Yes. The more the company uses it, the more data flows through the system, the smarter the AI gets, and the harder it becomes to ever leave.
Okay, so that sounds incredibly formidable. We got the fundamentals, we have this massive moat. Let's pivot to the mood, the sentiment. Because like we said at the top, the stock is down 24% this year. Is the news flow actually bad right now? Like, is there a hidden scandal?
That is the most fascinating part of this whole disconnect. The sentiment scores in the media are actually neutral to highly bullish. The news flow itself is incredibly positive.
So why the drop?
It's mostly the macro environment. It's that broader software sector rotation. But if you look at the specific headlines surrounding the company, they tell a very different story about their power in the ecosystem.
I actually saw something earlier about the Rackspace effect. What exactly is that?
Oh, this is one of the most telling signals I've seen. Rackspace, the cloud computing company, their stock recently surged 50%.
50%? Why? Did they release a massive new product?
No, they surged 50% solely based on the hype of an AI partnership with Palantir.
Wait, so
Yeah.
just by putting out a press release saying, hey, we are working with them, their entire valuation jumped 50%.
Yes. It's pure ecosystem momentum spillover. They are effectively becoming a kingmaker in the market. If you partner with them, Wall Street assumes you are going to win your category.
That is incredible power. It reminds me of the early days of Microsoft or the Apple App Store. Just being in their orbit instantly made you valuable.
Exactly. It signals that it isn't just a standalone stock anymore. It's an ecosystem that lifts all the other boats. And it's not just commercial hype either. They also just landed another $1 billion government deal.
$1 billion. Well, that pretty much validates their total dominance in defense.
It absolutely does. And there's also this really interesting Palantir Mafia effect starting to take shape. There's a startup called Wraithwatch, which was founded by alumni, and they just secured a $30 million federal contract.
So the talent leaving the company is going out and building their own successful defense startups.
Exactly, which just continuously expands the network and the influence. ISG is actually conducting a study right now just to assess all these ecosystem partners. It's becoming the gold standard for the next generation of tech.
Okay, I am getting hyped up here. The story sounds completely bulletproof, but we have to be responsible. Let's look at the other side of the trade. Why shouldn't someone buy this stock today? What is the actual bear case driving that 24% drop?
The elephant in the room with this stock is always valuation. Even with this recent 24% haircut, it trades at a massive premium. We are looking at a forward price-to-sales ratio of around 67.5.
67 times sales, not earnings, sales.
Yes.
That is rich. I mean, the S&P 500 average is usually in the single digits.
It's incredibly high. It is priced for absolute perfection.
Right.
And the risk there is multiple contraction. If their growth slows even a fraction, let's say next quarter they report 40% growth instead of 60%, the market could punish them violently.
So the stock price could get cut in half just to reach a normal expensive valuation.
Correct. You are paying a heavy premium for that 60% velocity. If it drops, look out below. And that is exactly why the current software rout is hitting them so hard. When the market gets fearful, asset managers de-risk. They sell their most expensive, highest multiple stocks first. Morgan Stanley actually put out a big note about this exact sector rotation.
So it's not necessarily about the company doing something wrong. It's just asset managers taking their most expensive chips off the table.
Precisely.
What about the competition, though? You mentioned Big Bear earlier. Are they a legitimate threat to those sticky government contracts?
It's definitely a risk you have to monitor. Big Bear and a few others are absolutely gunning for those military AI contracts, and the government naturally likes to diversify. They really don't want to be relying on just one single vendor for their entire tech stack. But my counter-argument to that would be that the platform breadth, having all four of those pillars integrated, kind of prices this risk in. Big Bear might win a niche contract here or there, maybe for a specific drone program, but can they run the entire global logistics network for the U.S. Army? Not yet.
Okay, so the bear case essentially boils down to it's incredibly expensive, the macro market is fearful, and perfection is already priced in.
Yes, but if you believe the core growth story, if you believe that 60% growth rate and the U.S. commercial explosion are sustainable, then that premium valuation is entirely justified.
All right, let's bring this all home. We've looked at the massive growth, the unique fortress moat, this really weird market disconnect, and the valuation risks.
Yeah.
What is your final verdict? Give us the score.
I'm giving this a bullish score of 9 out of 10.
9 out of 10. That is high conviction, especially in a fearful down market.
It is. Look, the disconnect between the underlying business performance and the current stock price is just too wide to ignore.
Yeah.
You very rarely get a chance to buy a company accelerating this fast at a 25% discount from its recent highs.
And where do you actually see the price going?
Well, 24/7 Wallcent has a price target of $202.50 by the end of year 2026.
$202.50.
Wow.
From where we're sitting today, that is some serious upside.
It's a massive recovery. And here's the quick elevator pitch for why I think it gets there. AIP is driving 63% overall revenue growth. That is real. U.S. commercial is exploding at over 115%. That is real. And their margins are elite, sitting at 40% GCSAT. That is real.
The business is real.
The business is fundamentally real. This 24% dip we are seeing year to date, I view it as a massive buying opportunity before the Q1 2026 earnings hit.
And when do we expect those Q1 earnings?
We're expecting them late April or early May.
So we have a relatively tight window here to act.
We do. My strategy right now would be a multi-year hold. You buy into this current macro weakness and you just hold it into the 2026 earnings acceleration. This is not a quick day trade for next week. It's a fundamental trade for the next tech cycle.
So what this all means for you listening is that the market might just be wrong right now. Fear might be creating a disconnect that a savvy investor can exploit. The company's fundamentals are screaming buy, even while the broader market tape is screaming sell.
Perfectly said.
Before we wrap up today, I want to leave you with one final, slightly provocative thought. We talked about that Rackspace anomaly earlier. Rackspace stock jumped 50% just because they announced they partnered with this platform. Think about that. If this platform has the power to double the value of other massive companies just by letting them into the club, what does that say about the true underlying value of the platform itself? Are they just another enterprise software company, or are they quietly becoming the kingmaker of the entire AI economy?
That is the trillion-dollar question right there.
Thank you for tuning in to Smart Wealth with Joshua. We'll catch you tomorrow.